Stock market hits a wall. Economic headwinds loom. 0.5% of interest rate hike. It's not surprising news that odds are on now after a Fed Powell's testimony back Tuesday. More hawkish than many times before. So it's a cold shower for markets after such a brisk rally. But what could it mean for investors and for the economy? That's a new episode of Blockrevision. I'm very glad to host you today. And without any further ado, let's head on to intro. Alright, so first topic to cover is economy view, and we had yesterday's speech of Jerome Powell that found that right now they are more open for next interest rate hikes than before, and that's what literally shaking the market. Right now we have many data that may impact Fed's decision on 22nd of March, and right here you have target rate probabilities for that date, and right after this this speech, the probabilities of 0.5 interest rate hike has surged to 3/4. So it means that after, maybe I'll take it to historical. So after this one meeting, the odds has risen to that very high levels. So previously, this gauge has been rather marginalized when we have expected to hike by no more than 0.25. Right now, the markets are reacting to these hawks that we've met yesterday, and right now we are heading to higher certainty of a rising of that high level. So it means that we still have some way to go with interest rate hikes, and as a reminder, as a tough reminder, there wasn't a recession back in the history without interest rate cuts. So we still are in a period of hiking, but after this plateau period, when cuts will eventually turn up, we may find that the recession might be knocking at our door. Right now, we are still kind of a in this safe territory, where relatively safe territory, where we are rising interest rates, but we don't find the cracks in the economy as of yet. That's only leading indicators that are pointing that something is going on, but a lagging one that the Fed is taking care of surprisingly the most right now are doing well. That's why we are hiking interest rates further, and for us we can find that Mr. Powell might be right pushing to the limit the economy, and we will just have an insight of what will happen and what will be the result right in 2024, not earlier. So that's kind of worrisome, and right here you can find that bonds are saying Powell willing to break the economy. So we are getting to around of 5% in Treasury 2-year yield, and on with 4% on the 10-year yield, and it means that this right now this conversion is pointing that we are more likely of heading through headwinds, and that's what the smart money are betting on. Right now, let's find out. The one thing that might be of an optimistic vibe is that the bottlenecks are fading away. Anyway, Fed's global supply pressure index fell below normal in February. So after this COVID supply chain disruption, we had much of a problem of a supply side of inflation, and right now the only or maybe not only, but the major threat to still maintaining high levels of inflation is this threat of Russia-Ukraine war still prolonging, and that's what we take care most about, is when this fight, this war will eventually end up, and those bottlenecks will eventually vanish. So right now, the positive side is that those elements of sorry for my throat, I didn't take the water. So the only one thing that right now has been bothered policymakers recently were these COVID restrictions right now, with China getting back to normal and so on. As we just have a look right here, global supply chain pressures are already receding before reopening, but as we do know, China may reopen, and that may give another shock for the supply side in a few months. So we'll find out. Right now, the things are going from bad to better, but eventually this inflation may not go away, with China getting back to the table very, very soon. So that's why we not only are worrying of a Russia-Ukraine war along this element of China reopening, but we are also carrying off this payrolls that has recently undershot for 10 straight months, and that's very surprising, as we may find non-farm payrolls are expected to point 210k, whereas the previous one was 510. So right now it may overshoot once again, and gives another reason for Fed to hike even more. So I do expect that we will beat once again this 210k, and the market will dive right after. So that's the thing we need to consider in our trading or investing. But right now, let's find out what about the market outlook, and inside, let's find out what about this next period of time where we have implied volatility of particular events, and we had a Powell testimony already. This volatility tip has found to get us to 22 points, but we are still ahead of payrolls, so the market expects that payrolls will imply volatility of an even higher extent than the Powell testimony. And right after, on 14th of March, we have CPIs that may eventually rise. If it rises, right now, let's find out what's the forecast for CPI, core inflation rate. Inflation rate is supposed to get us to 6.2%, but after those PCs, I do find it will be very hard to achieve. So that may be a hard nut to crack for many market bulls. Right now, we can find it very packed with important events time ahead of us, and it will be very difficult to be aware of the most volatility inflicted events right on the way. But even though many of those elements of economy pointing that we might be heading through a headwinds, in the long run, as long as the majority of the market betting on that will be a bad year for stocks, the higher odds are that it may act in reverse. So we can find that retail are betting that it's better to keep a cash holdings. So 2/3 of them are assessing that it's better to keep your cash holdings instead of investing. Alongside professional also share that view, and we can find that that's the thing that pushing me more into a medium to short time downward pressure by this next Fed meeting, but right after it, we may see a rebound that may get us to at least medium-term highs. So this year after medium-term election has been in a historical way a positive year. So I do expect that we may try to get to higher valuations within next quarter, and it will be very important how the Fed will react to the coming inflation. But I do expect that we are more closer to this than not, and even if those PCs or CPIs gauges will rebound a little, it may stop around this 6-7%. So that's my point of view on that case. And also out of the crypto outlook, we had also Fed Chair Jerome Powell this take on crypto. He finds that so maybe it wasn't much of a interesting shocking news to the market, but he finds that the crypto suffering from lack of transparency, and that's something that they need to tackle with and induce regulations that may deliver this type of transparency they desire. So right now, 2023 looks like the year of a permanent battle between regulators and speculators, right? So this will be much more hiccups on the way than we expect, and definitely the case with Coinbase, with CFTC, with security tokens and staking must be resolved in order to having that both coming up for 2024 that I expect will eventually come. All right, so in terms of market movers, we are heading through economic calendar, and on Tuesday, oh sorry, that's not the tweak. So right here we can find that Bank of Canada interest rate decision is along the way at 10 a.m. At 10 a.m. each time. Balance of trade of Canada, is it? refreshed? Sorry, I haven't refreshed it. So balance of trade has been delivered positive. Out of US, it's still at the similar level of minus 68 billion, so it's a deficit. Fed Chair Powell testimony, another we have at 10 a.m. Inflation rate out of China. That's also worth watching in order to find out where we are right now. Where we are right now at the economic cycle in that country. And tomorrow we have Bank of Japan interest rate decision to also take a notice at. Okay, so right here we have earnings calendar, and at earnings calendar on Tuesday we had C Limited that surprise to the upside. Just look at this, 168% of surprise, and CrowdStrike has slumped. So that's the thing that also justifies that this recession, this shadow of recession, is also weighing on those IT companies that related to this security sector. So that's the two of most important. Today we have Prudential, and tomorrow we have an Oracle and JD that come alongside DocuSign. So that's it out of that topic. Right now let's find out what about trade idea, and I do have for you a very interesting commodity that is Palladium. And so Palladium recently, just look at the chart. So Palladium has recently been in a constant slide, when after having its medium-term peak at 3rd of October is getting a downward tendency that is lasting by today, and we still have some room to get downwards. We are trying to rebound out of this temporary floor at 1350-ish, around 1360-ish, and after building some power for another ride downwards, we may hang along right here within this zone for some time. But if we find right here major weeks of candles, we may find that it will be hardly possible to get it through and push this Palladium even upwards. So I would expect that the price of Palladium will stop around this level, this congestion area. If we just, oh, that's not it. So I do expect that Palladium will find a kind of a supply pressure out of this level of 1390 and 1399, and I do expect that this territory will be the one where we will rebound out of from, and out of which get another strike downwards. So on a daily chart, it looks like we are right now building some power to breathe in order to breathe out once again. And if we just zoom it out, we may find that there is a major support at 12 70, and I do expect it's where the XPD will eventually be driven. So if I may drive the possible traction, that might be like this, and with a trough possibly somewhere around this Fed meeting on 22nd of March. So if we just want to if like to look at fundamentals, we may find that commercials right now on Palladium are increasing their positions. So it's unfortunately the data, the bar chart hasn't updated its data, but we may expect that with this slide, this commercial position may increase even further. So there is a demand. There is a upcoming demand for XPD, for Palladium, but until we won't hit a very important support, the resistance wouldn't find its place within up by that time. So so Palladium right now, in my view, looking as need to validate this level of 12.78, and I do expect that this trade of this trade that might give us an around 8.5% is the one to achieve. And always remember about protecting your trades, and never lose more never risk more than you thought to lose. So in my view, XPD is the one to consider at the trade against. So that's it in today's episode. Thank you very much for watching. If you have any questions, just put it in the comment section below. And if you haven't noticed, the chat was going live. So for the next time, so for tomorrow, I do remind that you may pose questions going live, and I will get back to them as soon as possible. So that's it. Thank you very much, and